How's everybody doing this afternoon? All right. Let me get everything set up real quick. So yes, we're going to talk about how to keep more of what you earn, aka dominating cash flow management with Profit First. Then we're also going to sprinkle in some tax planning strategies. Are y'all wanting to do that? I mean, it's tax season, right? All right. So how do I use this switch? Before we get in, who is Ephraim? So Ephraim is a University of Houston graduate. How many Texans are in the room? All right. Graduated from University of Houston in 2006. I'm a husband and father of twin boys, two 6-year-old boys. And I worked at PricewaterhouseCoopers back in 2008 as an audit associate. How many of you guys remember the economy back then, that 07, 08 timeframe? Yeah. Like yesterday, right? I was one of the people that got laid off from my job during that time. And I'm thinking, okay, what's next? I'm on the job market. I'm looking for work for 6 months. I'm getting interviews. Everyone's like, oh, we love you. We'll call you. Don't call us. You know, that type of thing. Nothing happened in that 6 months. And I said, you know what? I got to take matters into my own hands. I got to start my own business. So here we are 16 years later. I have EFS Group PLLC, managing director of that. We have about 21 people on our team. Gustavo, who just gave a presentation, for those of y'all who were in the breakout room, is one of our star members of our team, right? So we're growing and everything's good. And one of the things that happened with EFS Group, when I first started, we were primarily a tax preparation company, right? So think of H&R Block having a location and people were coming in, they're doing their taxes. We had about 800 to 1,000 people that we were doing taxes for. And one of the things that I kept getting from people was, man, I'm an entrepreneur. You guys are helping me with my taxes, but I only get to see you once a year. Like, is there anything else that you can do? Because I'm making money in my business, but I'm not managing it properly. I'm not managing it well. So that really set off something in my mind. I was like, you know what? I need to make a pivot. And then those of y'all who watch TV, you see all the TurboTax commercials, right? Over the years, TurboTax, what are they telling everybody? It's so easy to do your taxes. You would be an idiot to hire someone, right? So that directly impacted my business, so to a point where I had to make a change, right? So we started to be more of a fractional CFO company where we work with clients on a regular basis. And I like to tell people that our mission is we're here to help you manage your money so that you can scale your businesses with confidence, right? So today, we're going to talk about dominating your cash flow management with Profit First. We're going to talk about why cash flow is the lifeblood of your business, the Profit First mindset shift, the Profit First bank account system, how to implement Profit First step by step, facts about Profit First, and last but not least, 6 tax strategies that can help you keep thousands of dollars in your bank account. So before we go in, how many of you actually have heard of Profit First? Is there anybody in the room that's heard of this methodology? Profit First? Have y'all ever heard about that? Okay, one person. So Profit First is a money management methodology that was created by a guy named Mike Michalowicz. So there's a book out there that you can read that goes deeper into this methodology. Profit First, whenever you buy it, I think it's like a blue book. It has a pig on the front of the cover. And the whole thing with Profit First is really structuring the mind frame of how you think about your business, right? So traditional accounting, how we think about our money is sales minus expenses equals profit. But with this methodology, it's sales minus profit equals expenses. So essentially, it's all about, I'm the owner of the business. I need to take care of myself first and then take care of everything else in the business next. Because if I'm not in a good place to manage the business, then guess what happens to the business? It starts to go down, right? So how many of you know that 82% of businesses that go out of business is because of poor cash flow management? Right? Whenever you think about your cash, if it's not coming in properly, if it's not going out slowly, things like that, there's a lot of turmoil within the business, and at some point you might go under, right? So that's why Profit First is a good system to implement. So the Profit First mindset shift. You must prioritize profit from day one. So Gustavo talked about profit whenever we talk about gross margins, right? A lot of people, whenever they come to work with us, they'll say things like, I don't really care about profit too much. Like, I just want to make sure that, I have a business that's making money. And, as long as I spend it on the things in the business that's necessary, then I'm going to be in a good place. But if you're not prioritizing profit, then at some point you're going to go out of business, right? Because why are we in business? We're in business to obviously help the people that we're serving, but it's also to make a profit. And if we're not in business to make a profit, we need to be what? A nonprofit, right? I mean, it just makes sense in my head, right? So Profit First creates a disciplined system for financial success. And we're going to dive into like the different accounts and how it works. But essentially, it's a system that helps you operate within your means, right? So the Profit First bank account system, this is where it gets really, really good. And before I jump into this, I want to talk about this, right? Because this is something that really impacted me personally. In 2019, I read the book and I started to implement this system into my business. And it got so good that I started saying, you know what? I can't keep this to myself. I need to implement this with all of our clients. And guess what happened the following year, 2020? COVID-19, right? So many of us who were in business during that time, we didn't have money coming in for like a 1 to 2 month period, right? Because everything shut down. And so we had to wait for the government to give us PPP loans, EIDL loans. If you're in California, you have the EDD, unemployment, right? Things like that. But because I had been implementing this in my own business and have been helping our clients implement this, we had cash reserves that we were able to still pull from to now pay our employees, not have to furlough them, right? They were still able to be, operating because we had the money put aside. So that's the biggest thing with this, right? Like, how can I create cash reserves of, let's say, 2 to 3 months in my business so that if anything was to happen, if inflation increases, if interest rates increase, if our president, might do something to where, things might not work in our favor for our business, right? How do I still stay within business? So that's what Profit First is a really good system for. So here's the bank methods, right? So you open 5 bank accounts with Profit First. 3 of them are checking accounts and 2 of them are savings accounts. The number one most important account is your income account. Then you have your owner's pay account. Then you have your profit account. You have your tax account. And last but not least, you have your operating expense account. So your profit and tax account are savings accounts. And then the other 3, your income, owner's pay, and expense accounts, are checking accounts. You want to do them all at the same bank. And we'll talk about that more, about why that's important. But these are the 5 core bank accounts that you have whenever you're operating this Profit First methodology. And so we're going to talk about the purpose of each of these accounts. Before I continue, how many of you you're operating your business out of one bank account versus like more than one? Okay, a few people. Yeah, so I know a lot of people, they'll say, I got to have 5 accounts. Like, am I not going to get overdraft fees? Not overdraft, but like maintenance fees and account fees and things like that. Not necessarily, because as you manage the money, it's going to help you to have it at a really good balance to where you don't have those fees. But the purpose of each of these accounts, right? Your income account, this is strictly where all the money that you make in your business goes into. So however you collect your money, whether it's through Stripe, Cash, PayPal, your merchant that you might have in person, some people use Clover, whatever it is, all that money goes into your income account. The next account is your profit account, right? That's the bonus account. That's where you give yourself a reward for how well you're running your business from a financial perspective. Your owner's pay account is obviously the money that you'll use to pay yourself a salary. The tax account is one of my favorites because it's an account that obviously is there to not only help you pay your taxes at the end of the year, but to help you tax plan throughout the year, right? So when you work with us, we meet with you once a quarter to go over your numbers and estimate how much taxes you probably would pay at the end of the year. And, for some people, we'll say, man, you're projected to pay about $100,000 to the IRS. We got to start jumping into action right now. What can we do to make that bill go down? And so whenever we do these things, we need to spend money, right? Because in order to pay less taxes, you have to do what? Spend some money. So where does that money come from? It comes from the tax account that we've already been building. And then last but not least, we have our operating expense account. That's where all of our other expenses, your rent, your utilities, marketing, things like that. This is the account that all that comes out of. So the power of percentage allocations. If you are a business that makes under $250,000, these are the percentages that you would be transferring between your accounts every 2 weeks, right? So profit 5%, owner's pay 50%, right? So pretty much in this methodology is saying, if I make $250,000, 50% of that money should be for me. Tax 15%, and then operating expenses 30%. So as your business grows, they have other different percentage allocations, right? So I would say from 250 to 500,000, it's a different percentage allocation. From 500,000 to a million, a different one, a million to 5 million, and so on and so forth. And if you guys fall out of that 250 range, if your business is higher than that, send me a DM on Instagram, DM me the word summit, and I'll send you the percentage allocation so that you have that as you're implementing this into your business. All right, here's a real life case study of Profit First in action, right? So we had someone that we were working with, trucking company, FedEx route. They had about 35 trucks that they had in operation, right? And they were struggling with cash flow, because one of the reasons why they were struggling with cash flow is because FedEx pretty much gives them the amount of money that they can make off of each route. So when that happens, it's like, okay, we only have a few other levers that we can pull. We need to manage our expenses, or we need to figure out how to increase our operational efficiency, right? So before they worked with us, very little to no profit, inconsistent owner pay, tax bill surprises left and right. And then after implementing Profit First, steady profit, we were able to get them to pay themselves $100,000. That took about 6 to 12 months to really get that into place. But they were able to pay themselves a 6-figure salary and minimal to no tax bill surprises, right? And so the results is the business became more profitable without having to increase sales. So there's opportunity for you guys to do the same thing. So here's how to implement Profit First. I know y'all are probably saying, okay, this is good. You gave me the bank accounts, you gave me everything, but how do I do this? We're gonna jump into that. Number one, we spoke about that, the first thing earlier, you open the 5 accounts, and then you set your percentage allocations, which whenever you send me that DM, I'll send you, the allocations for the revenue level for your business. And then twice a month, we like to tell our clients on the 1st and the 15th of the month, take 5 minutes and do the transfers, right? So however much money is in your income account, based upon the percentages, you would transfer a percentage to your owner's pay, your tax, your profit account, and your expense account. And then now for the next 2 weeks, that's how much money you have in each of those accounts to spend on your business. And then last but not least, you adjust the percentages over time, right? So in your mind, if you're saying, you know what, let's say Ephraim is saying in Profit First, I need to transfer 65% over to my expense account. But as I'm doing that, I'm seeing, you know what, my expenses are about 80%, right? A lot of times people say, well, I can't do this. Well, that's where we get really creative. Okay, what are the things that we can reduce in our expenses? I like to tell people whenever they're working with us, look at each of your expense items, and is that expense an expense or is it an investment, right? This is how we need to look at everything that we're spending money on. Whatever we're spending money on needs to be returning us investment, right? It needs to have an ROI. And if it doesn't, then that means that we need to either eliminate it or we need to replace it with something that's going to help us to, return on our investment. Now, the psychology of small plates. The thing I like about Profit First is that it forces you to work within certain parameters, right? However much money you made in that 2 weeks is whatever you transfer from that is how much you have to spend, right? So your tax account is going to continue to grow because you're transferring to it every 2 weeks. Your profit account is going to continue to grow because you're transferring every 2 weeks. But your owner's pay is going to go up and then it's going to go down, right? Because you have to pay yourself. And then your operating expense, that's the most important account because that's the account where you spend everything, right? Your rent, your utilities, marketing, all those things. So now it forces you to psychologically say, okay, I might not have enough money for these next 2 weeks. What do I need to do? What do I need to pretty much cut or replace? And when you limit the money available for expenses, you become even more efficient in your business. Now, for those of you who are probably saying, how do I cut unnecessary expenses? Like I was saying earlier, right? Going through and looking at what are the must-haves, what are the expenses that's going to help me to grow my business, or what are the expenses that necessarily might not help me? If you're like me, there might be times where you might get a software expense that you might just say, you know what, let me sign up for this. But then you may not be using it. and you're still paying for it, right? How many of us have software subscriptions that we may not be using, right? It might be Netflix, it could be Hulu, whatever it is, or something in our business. That's the first area of opportunity for you to say, you know what? I might need to cancel this for right now. That doesn't necessarily mean that I have to cancel it forever. I can bring it back whenever I'm ready, but I might need to cancel that out right now so that I can get my expenses to be in a certain place. And then payroll. That's a very touchy one, right? How many of you have ever had to lay off anyone in your business at some point? Right, a few of you, right? So payroll is something that we have conversations with our clients where it's like, you know what? In this season of your business, you have 10 employees, you might need to only have 8. You know, and that's a touchy subject because as entrepreneurs, we're in business to not only help our clients and our customers, but we also have responsibility. We have employees that depend on us to go to work every day, generate sales, make sure that they are able to get paid every 2 weeks. But sometimes in our business, we may not be able to generate money. So we have to make that tough decision of saying, you know what, I might need to let someone go, but I keep that relationship with them. And then whenever the business gets back together, I can always bring them back. You know, I like to tell people that just because you let someone go doesn't mean that you can't bring them back in the future once your business gets better. So also another thing that you can do is renegotiate contracts. Any contracts that you might have with vendors, if you have a great relationship with them, go to them and say, you know what, we've had a relationship, but the payment terms, is there a way that we can make it to where it's better for my business? Because right now I might not be generating enough revenue to stay in this relationship. And so most vendors, instead of them losing the business from you, they'll have that conversation with you and say, you know what, let's sit down and let's work something out. I think that there's something that could be a solution. Now, how to increase profitability without increasing sales, like that first case study, right? Raise prices. So one of the things that Lamar talked about earlier today was raising our prices. You know, like every year to 2 years, if we're not raising our prices, inflation is pretty much killing our margins, right? Our expenses increase. So if our expenses are increasing every year, we need to really look at our pricing and say, you know what, that might need to be adjusted as well. Improve operational efficiency. That's one of the things that, you know, we've been looking at within our company, like the way that we operate. Is it as efficient as it should be? Are there areas of improvement? Are our systems and processes really, really good? Do they need to be updated, right? I always say, look at your systems and processes every 3 to 6 months and figure out, are there things that we can do to improve the efficiency within how we operate? And then upselling and cross-selling to existing clients, right? If you have clients that are working with you right now or that are buying from you, they may be open to buying other things from you as well, right? If you just give them that opportunity to do that. And then focus on high margin products. So like Gustavo said earlier in the breakout meeting, what is the gross margin of what I'm selling, right? If I'm selling a bunch of different items, I need to know the gross margin on each of them. What is the profit that I'm getting? That because the gross margin essentially is the money that's going to cover all the rest of my expenses in my business. So if all of my products that I'm selling have low gross margin, then at some point I'm going to be in trouble. I'm either going to have to go get a loan or I'm going to have to pull money from my own bank account to continue the business growth, right? So these are ways that you can increase your profitability. Now, there's 4 common mistakes that people make whenever they're implementing profit first. Number 1, not sticking to your allocations, right? So whenever you have the percentage allocations, there might be a time where you might say, I don't necessarily want to stick to the allocations that have been given to me based upon where I'm at in the business. That's a surefire way to put yourself in a disadvantage whenever you're doing profit first. Because the allocations are there for a reason. They're forcing you to say, I need to make changes within how I'm spending. You know, number 2, using the profit and tax account as business expenses. So these accounts, like I said earlier, they're growing every 2 weeks when you're making these transfers. But if you're seeing that money grow and you're saying, I got $50,000 here. Why is it here? I can use that money and I can spend it on something. That's going to put you at a disadvantage whenever it comes tax time or whatever it's time for you to do profit distributions to yourself, right? So really focusing on the operating expense account for your expenses is the way to go. And the last 2, underpaying yourself. Let me ask you guys a question. How many of you are paying yourself your market value? This is a common thing that happens in business, right? Underpaying ourselves. And it's something that a lot of times when we underpay ourselves, there's several reasons why, right? We're doing that so that we can have enough money to take care of everything else, take care of everybody else. And we're also doing that possibly because we might have been advised by someone in tax, like a tax advisor. They might have said, hey, pay yourself a slower salary so that you can do this or that. Paying yourself low is a bad thing because in the future, if you're ever trying to sell your business, this is one of the things that investors are going to find a way to take advantage of. Because whenever you sell your business, an investor could say, you know what, me as a CEO, if I buy your business, I need to be able to slide myself into your business at the same salary that you're paying yourself. But you're only paying yourself $50,000. So therefore, the profit that you're saying that you're making and that you're trying to say, hey, the value of my business is higher, is actually lower because instead of you paying yourself more, you're manipulating everything so for your profit to be higher. Does that make sense? So paying yourself a market salary just for that very reason is extremely important. I've seen it time and time again when we've helped clients exit their company, and that's one of the negotiation tactics that people use whenever they're trying to buy businesses. So that's why it's really important. And then last but not least, ignoring your financial reports. So those of you that have bookkeepers, accountants, are you meeting with them every month or every 2 weeks, every week? Are you going over your financial statements? Are you understanding what's going on in your business from a financial perspective, right? A lot of times whenever we start working with clients, they'll say things like, yeah, I'm managing my business from my bank account, right? And your bank account might have $100,000 in it, but that doesn't mean that your profit in the business is $100,000 because there's different factors that impact how much money is in our account. So really looking at those financial reports and seeing to yourself, okay, this is how my business is operating, and really having that conversation with your financial person and having them explain, hey, Ephraim, this is what I'm seeing in your business. These are the changes that you need to make in order to hit the goals that we discussed whenever we first started working together, right? These conversations are extremely important. All right, the quarterly profit distribution strategy. So y'all, this is one of my favorite things about Profit First, because in Profit First, we talk about paying ourselves a salary from the owner's pay account. But how many of you are giving yourself a profit distribution as well in your business? Okay, we got a few hands. I love it. So Profit First, how this whole thing works, right? You transfer money every 2 weeks on the 1st and 15th. And so your profit account is growing. And then now at the end of each quarter, which quarter one's about to end literally in a few days. So all of our clients, what are they going to do? They're going to celebrate because this is an opportunity for them to now take a profit distribution in their business. So let's say you have $50,000 in that profit account that you've accumulated over this first quarter. You take 50% of that money and you put it into a different savings account as the emergency savings fund, right? So now you have money if anything was to happen. And then the other 50%, you get to give that to yourself as a bonus, right? So that other $25,000 is a bonus to yourself. For those of you who might have debt, this is a perfect opportunity to say, you know what, I'm going to take a little bit of, or all of this money and pay down this debt. Or if you don't have debt, you can say, you know what, I'm going to enjoy a vacation. You know what, I had a goal that I set for this quarter. I hit that goal, and this is the money that I'm going to have to celebrate that goal, right? So one of the things that we did for spring break a few weeks ago, me and my family, was we did a Disney cruise out of Galveston, Texas. Disney Magic for 4 days. And we were able to pay for that from the profits of the quarter 4 of December 2024, right? So these are the things that you can do. And I love business because you literally can grow a business that will take care of your lifestyle, will take care of the people in your family, will take care of the customers and the clients that you serve, and will literally do whatever it is that you want, you know? So this system helps you to realize all the money that's coming into your business. And it also builds a strong financial foundation. So we're going to talk about how Profit First helps you pay yourself first, right? So like I said earlier, the new equation that you have to look at when it comes to your money is sales minus profit equals expenses, right? So Profit First is a system where it's all about, as the owner, how do I make sure that I get paid every 2 weeks? And I'm not like skipping payroll for myself as the entrepreneur, as the owner of the business, right? So this system focuses on making sure that you get paid first. And then the owner's pay is non-negotiable, right? We can't skip payroll anymore. If we're skipping payroll, there's something wrong in our business from a financial perspective. And we need to figure that out with our accountant. And then last but not least, it creates stability and prevents burnout. So how to prepare for taxes using Profit First. So I like to say that you want to treat your taxes as an actual fixed business expense, right? So across the board, whatever level you're at in your business from revenue perspective, the percentage that you'll transfer to your tax account is 15%, right? And so you avoid tax bills by putting that aside. And the beautiful thing about working with us, like I said earlier, is that every quarter we're looking at your profit. Where are you at? And we're doing projections. And we're trying to figure out what is your tax bill going to be by the end of the year. And so now we're getting proactive. We're coming up with all kinds of creative strategies. Some of them I'll talk about in a little bit. And then we have our clients implement them. And so now the money that they use to implement that comes from what? The tax account. And it helps reduce the stress and the payment and penalties, right? Because as you know, if you don't pay the IRS on time, even if you owe, let's say you do an extension, right? And you don't pay them money on what you feel like your bill is going to be estimated to be by April 15th, the clock is going to start to tick if you end up filing your tax return later and you owe money, right? So with this method, you have the money to go ahead and send that payment to the IRS if need be. So I want to show you guys an example of Profit First in action. This is from a client of ours. They allowed us to share this with you guys. I've asked for their approval. But this is from 2021, 4 years ago when we started doing this with clients. As you can see in this example, they have a few more accounts outside of the accounts that we talked about for the 5, but they have their revenue account, which has about $11,000 in it, expense account, $39,000, their owner's pay, $77,000, the marketing had $91,000. So with this, you can create a marketing account out of the expense account, right? So we have the expense account that I said earlier. It covers all these different expenses. If you want to go a step further, you can say, you know what, I'm going to pull marketing out of that expense account and I'm going to allocate a certain percentage to it. And so that's what they did. And then the profit account, the tax account, and the drip account. So the drip account, for those of you who are probably wondering what that is, let's say you have a big project that you're planning out for, right? So like how Bill and Angela have this conference. This is not something that you potentially can just say, you know what, I have enough money in my account, I'm gonna just pull it out and pay for it. You gotta start planning ahead, right? So a drip account is an account that you can now use for research and development, a big purchase that you might have in the future, events, whatever it is. You're putting money aside into that account and you're preparing for that. And so now whenever the time comes for you to spend that money, you have the money that's separate from all your other money that you're operating in your business. All right, and so for those of you, whenever we work with clients, we use a Profit First spreadsheet. And we introduce this to them and they're able to use this whenever they're doing the transfers. And literally it takes like less than 5 minutes to do. And once you put in like your account balance into it, it spits out all the different transfer amounts that you need to do for that day. If you guys are interested in that spreadsheet, send me a message on Instagram, DM the word summit, and I'll send that to you guys as well for being here in the room. All right, here's a real life case study number 2 of Profit First in action. This client of ours was a 7-figure business that was struggling with spending money. So a lot of us, we don't have problems spending money, but there's a few of us that have problems actually spending it, right? How many of you are like that? How many of you are like that or know someone like that that holds on to money? Hey, it's not a big deal, right? Because these are things that we can work ourselves through. So with this person, because they were doing things like that, they had slow growth in their business. They had a $110,000 tax bill at the time, and they were working too hard. They were trying to say to themselves, you know what? Because I'm scared of spending the money, because I'm scared of hiring people, I'm going to do everything by myself. And so all of us know in this room, whenever you do things by yourself, you burn out, you stress. But as we were working with them and we were allowing them to understand like, hey, you know what? Here are your numbers. Here's your profit. Here's your margins. You actually can go out and hire an assistant. You can go hire a helper, someone to come in to help take work off of your plate. They were able to do that over time. And so now some of the results they got after working with us, their bill went from $110,000 to $8,000. Faster growth because they were leveraging people versus doing it all by themselves. And they were able to work less, right? So the results are their business increased sales by $400,000 while maintaining profitability. All right, here's 3 facts, and then we're gonna get into the tax part, because I know y'all wanna know about tax strategies, right? So some facts about Profit First that you guys might be wondering. Number 1, can this work for small businesses and startups? Yes, this system is a system that can work with any size business. You don't have to be $1 million business. You can be a $100,000 business, a $50,000 business. This works with everybody. Number 2, what if I have existing debt? Like I was saying earlier, the thing that I love about the profit account is that you have a decision to make. Whenever you are transferring money into that account, and now it's time for you to take that 50% as a distribution to yourself, why not pay off that debt? So now you have more cash flow coming in. So that's an option that you can do. And from what I tell people, you still want to pay on your debt. You want to pay that monthly payment. But at the end of the quarter, you use that lump sum of money that you've built to pay down the debt much, much quicker. And then last but not least, how do I adjust if my revenue fluctuates, right? Because there might be times where you might have a 2-week period where you made 30,000, and then there might be a 2-week period where you made 5,000. So when that happens, you want to make sure that you adjust your percentages on a rolling average so that whenever that happens, you're able to withhold, or not withhold, but withstand, I guess, the revenue fluctuations. And another thing that you can also do is you can use your profit account for things like that, or your drip account to hold you over in that time frame. Now we're going to talk about 6 tax strategies to keep thousands in your bank account. And if you guys have seen or heard of any of these, let me know. Have you guys heard of the home office deduction, the S corporation, paying your children, the Augusta loophole, depreciation? We're going to go over these 6, right? These are just a few of the tax strategies that we implement with our clients to help them save thousands. So number 1, the home office deduction. How many of you know that if you have an area of your house that you operate out of, you can take the square footage of that area, divide that by the total square footage of your house, and now you have a percentage that you can multiply by the rent or the mortgage payment that you pay, the utilities, the electricity, the water. All those things can be deducted on your tax return, right? So this is a very lucrative strategy that a lot of people implement and that they miss. But when they work with us, they implement this because, you know, for some people, it saves them $5,000, $10,000 in taxes, right? So with this, like I said earlier, you want to measure the space that you use in your home for work, and then you calculate the percentage of your home that it makes up, and then you deduct that percentage from your home expenses. So I cover the rent and the mortgage, but then we also have the electricity that you pay, the water, the internet. There's so many different expenses that we have within our home that you can use in this deduction. Next, S corporation. How many of you are an S corporation? Okay. Nice. This is a strategy that a lot of people, it's marketed a lot online and people talk about it. But I always say it may not make sense for you if you're not there in your business. But the S corporation is essentially a tax strategy that you can implement to where your LLC or your corporation can be taxed as an S corporation with the IRS. So that means that in the eyes of the IRS, you are seen as an S corporation, but to the public, you're still seen as an LLC or a corporation. And the thing that I love about the S corporation is that the self-employment tax that you have to pay gets eliminated. Why? Because you have to pay yourself a reasonable salary, right? So if you are in this place where you're paying yourself a salary, now an S corporation helps you to eliminate all that, and you get to write off the salary that you're paying yourself as a deduction. And then you take additional profits, like we were talking about earlier, as distributions, and it's taxed less, right? So this is a very, very lucrative strategy that a lot of people implement. And an example would be if you earned $100,000, you're splitting it between your salary and your distributions so that you end up saving thousands in taxes. Next, depreciation. How many of you have a tax person that implements depreciation into your business? This is great. Depreciation saves us thousands, y'all. Like, I know many of you have vehicles, large equipment, right, that you can take the advantage of depreciating. So essentially, depreciation is whenever you have an asset that you've purchased, the government allows you to take a deduction on the wear and tear of that asset. Think of it like this, right? For those of you that don't know, if you buy a car, what happens once you drive it off the lot? It's worth less, right? That's depreciation. It's already depreciated. And so in business, you get to take advantage of that and write that off. So I love this deduction because it's a paper deduction that doesn't mean that I spent money. And I feel like President Trump is going to extend, a lot of the things that he put in place in his first presidency. But from what I remember, he had Section 179. That is a tax depreciation deduction that you can take where you can literally write off the whole amount of an asset. And I think last year it decreased to 80%, but I think they're in talks of raising it back to 100%. So I know many of us would love that, right? Like I love depreciation because that's when you can buy the big cars, right? If you want a personal vehicle that you want to use for the business and it weighs $6,000, 6,000 pounds or more, you can write off that whole purchase as long as it's in the business name and it's being used for your business, right? So that's a really big tax strategy. And another thing that I love about depreciation, whenever you're going to the bank for a loan, we don't like paying a lot of taxes, right? So what do we end up doing a lot of times? We end up writing off so many different things. But then when it's time to go to the bank for a loan, they're looking at you like, wait, your profit is only $10,000. I don't think that if I give you this loan, you're going to be able to pay this thing back. So it negatively impacts your business whenever it's time to sell it or whenever it's time to get a loan or anything of value. But with depreciation, what ends up happening is that's an asset that's on your balance sheet. And then now you get to write off that whole amount and it makes you to pay less taxes and it keeps your profit higher. So for those of you that may not be implementing depreciation into your business, this is a big opportunity. And you can go back 3 years on your tax returns and implement this if you haven't already for the past few years. So there's still opportunity for you to take advantage of that. Next, the work opportunity tax credit. How many of y'all are familiar with this tax credit? Okay. No one. This is good. This is good. So this tax strategy is where if you're hiring people from a certain group, the government is like, you know what, we're going to give you a tax deduction and a really, really good tax deduction. So when we say people from a certain group, a lot of times we're talking about veterans. We're talking about people that might come from a disadvantaged background, lower income, people that might have been in prison for a little bit, and so essentially people that are finding it hard to find work. The government's saying, you know what, if you're hiring these people into your business, we want to recognize that and we want to give you a tax deduction. So with this, in order to qualify for this, you want to make sure, number one, whenever you're hiring people, do they qualify for the credit? Do they fit the criteria that I just explained? And then once you find out that they fit that criteria, you immediately have them fill out some IRS forms. I think it's like IRS form 8505, I believe. I'll give that to you guys in the back once I finish or whatnot, so you guys know the exact forms. But once you fill those out, you keep them on record. You can scan them or you can put them in a cabinet, but you want to make sure that you have it on record so that if you were to ever be audited for taking this credit, you've already had the proper documentation in place. And so now you're able to take advantage of this credit. And so with this, if you hire someone that qualifies for this, you could save $2,400 or more on your taxes. So we have some clients that hire 20 to 30 people in this space each year. That's a lot of money that they save on their taxes for employing people that may not have been able to get employment elsewhere. Paying your children. How many of you put your children on payroll or pay them a certain way, right? Okay, a few. So when we say put your children on payroll, the thing I love about this deduction is that we're not necessarily actually putting them on payroll as W-2 employees. If they're under the age of 17, 3 to 17, you can pay them without putting them on payroll. And so now you take advantage of the deduction for paying them. And then you also are able to put money into their account for them to use or for you to use as their parent, right? And then once they turn 17 or higher, then that's when you actually can put them on payroll. So you save on payroll taxes by doing this strategy. And I like to tell people whenever you're doing this, you need to make sure that they are actually doing some real work within your business. So some of the things that you can have your children do: organization of the file cabinets, shredding, cleaning, right? I have 2 6-year-olds. I make sure that a couple times a week that they're shredding paper because I'm paying you, right? I'm putting that money into a bank account for them. And so now if I need money for something, let's say to buy some clothes, guess what? I can pull that from that account. So I've been able to, it's all about how can I transfer money out of my account without it being taxed, right? How can I move it without it being taxed? That's all tax planning is, right? What can I do to increase the income that comes to me personally without it being taxed on the backside? So I love this. If you're someone that has 4 to 5 kids or more, think about how much money you can save. On this example, you can save up to $13,850. So do the math. Multiply that by 3, 4, 5, however many kids you have. That's an amazing tax savings that you are now moving to your children's personal account, and you're not being taxed on that. And last but not least, the Augusta loophole. This is another beautiful tax deduction because it's all about paying yourself rent. And when we say pay ourselves rent, meaning what you can do is whenever you have team meetings, instead of going to the hotel and booking a room, you literally can do that meeting from your home. And so now when you do that meeting from your home, guess what? Instead of paying the hotel, you're paying yourself that money. So now that's another example of moving money out of your business to yourself personally without paying additional taxes. And you can do this up to 14 days of the year and up to $14,000 of deduction. So the way that I do it is I go to my local hotel, right? A hotel that I would do a meeting at. And I would say, hey, hotel, I need the pricing of what it would take to rent a room, the projectors, all the things they make you do, all the food they make you buy whenever you rent rooms. How much? I need a listing of all that. And I get that, and I have that as documentation. So now I have that in my file. So then I bring my team, my leadership team, to my house once a month. Some of the months, my stack, I might have 2 meetings because I want to make sure that I do 14 days of this. And then I have an agenda for the meeting, right? If you know anything about the IRS, they love to see documentation. You know, I've helped clients through IRS audits, and the ones that went extremely well is because we had our documentation, we had our receipts, our invoices, our POs, our agendas, we had all these things in place. And they don't mind you getting creative as long as you have a trail of what's going on, right? So with this, you literally can do those 14 meetings and you can pay yourself on average $1,000 per meeting on top of the profit distribution that you're giving yourself and on top of the owner's pay that you're doing for yourself as well. So all this is deductible in your business. All right. Next steps, right? Take control of your cash flow today. I want you guys some homework. Open up your 5 bank accounts. If you have 1 or 2 already, open up like 3 more. And make sure you do that at the same bank so that you don't encounter any kind of fees whenever you're transferring between banks. And then calculate your initial percentage allocations. If you guys send me that DM, I'll make sure to send that to you guys today. And then start implementing and tracking your progress, right? It's extremely important. And then last but not least, if you want to book a consultation with me, feel free to scan this QR code and we can jump on a call next week and talk about, how we can implement this in your business and then also how we can potentially work together. I appreciate you guys. Does anyone have any questions? If you do, feel free to ask.
Super helpful information. Yes, thank you. Thank you.
Thank you, guys.
ton of stuff that nobody thinks about.
Yeah.
Hey, Frank, one of the things the SBA said many, many years ago was that 80% of businesses fail within the first 5 years because they failed to implement a invoicing program properly. The invoices just slip by and they never get collected.
So when you say invoicing, meaning invoicing to collect money.
So like somebody comes into your shop, you do a job, they don't pay right away, you gotta send them an invoice.
Oh yeah.
You forget.
Yeah.
And you'd be surprised how many hundreds of thousands of dollars get slipped through the cracks.
Oh yeah. Yeah. So that's really, really huge, right? Whenever we talk about the sales and the revenue in your business, we talk about increasing prices, we talk about decreasing your expenses and all those things. But one of the big things that we fail to realize is how much accounts receivable do we have? Meaning, how many outstanding invoices do we have? And if we don't collect that money within like the first couple weeks to a month, now a lot of times that money gets harder to collect, right? So I like you bringing that up because there's so much money that's probably sitting in our business that we haven't collected.
We get busy, and at the end of the day, we don't always send out the invoices. But if you don't keep up with it on a daily basis and send those invoices out, you may forget about it.
Oh yeah.
So according to your state, you can add late charges onto that.
Oh really?
If you don't pay by the due date, we're going to add another 5%. It varies by state how much you can charge.
I like
You can
that.
add late fees onto those invoices.
Yeah.
If they're not paid.
Yeah, that's a really good. So you can add on late fees. And another thing you can do is you can give them incentives to pay early. I might give like a 1% discount or something, like I'm trying to collect all this money. I know that, I've given you the service. I've delivered on all that and you haven't paid. Oh, well, I'm having cash flow issues. Okay, well, is there a way that you can pay this $10,000 balance? I'll give you 1% or 5% off. So now instead of the 10,000, it's 9,500 or 9,600. And it ends up being a win-win because that's money that potentially we could have lost. So there's different methodologies that you can use. Any other comments or questions? How's what?
Disbursements. How do they tax?
Disbursements?
Yeah. You got more money, profit or whatever.
Good question. So the thing about disbursements is that whenever you're taxed, it's all about what's the profit in your business, right? So you look at what your sales are, your expenses, you do that math, and then now you get taxed on the profit piece. So even though you're doing disbursements, the tax account, you can utilize that to, buy certain things or do certain things, right? To where your profit becomes lower. I like to tell people, buy assets, right? Because that's something that you can now write off and it doesn't impact your profit. And you can take the advantage of that. So that's a good question. Yeah. All right. Any other questions?
Out of the 5 accounts that you would set up, which one would you transfer most of your funding into, divide it out?
Out of the 5 accounts, which one would you transfer the most of your funding into?
You said the 5 accounts, which one would you dump the money into to transfer out of?
Oh, I see what you're saying. So that's the income account, right? So whenever you open the 5 accounts and you have the income account, you want to make sure that all the money that you're collecting is going to that account. And so now what happens is, let's say you make your transfers on the 1st. So now, let's say you had $10,000 in that account. You make the transfers, now it's $0. But then the next transfer is on the 15th. By that time, the money is going to be growing in that account. So it might grow to 20,000. So then you do it again. You transfer that 20,000 to the other 4 accounts. So yeah, the income account is it. Okay.
What is your take on the reasonable salary for an S corp?
Oh, that's a good one.
Depends who you talk to. I like it.
Yeah. So, and it changes each year, but as it stands right now, my take is I like to go look at market rate surveys to see for my role in the company, what should I be paying myself? And then based upon that, that's what I end up paying. And the thing about the IRS is they'll say, oh, you need to pay yourself a reasonable salary, but they won't give you any parameters around it. They leave it up to you to make the decision, and then they audit you if you make the wrong decision, right? So use a market survey to like really have that as documentation to pay yourself. Any other last questions? I appreciate you guys. Thanks for having me.
All right, thank you, Ephraim. That was a fantastic session.
No problem.
Taxes is always a big hard part of what it is to do as business owners, and it's often a great mystery. It's, but mishandling your taxes, mishandling your income, not understanding where your money's going, I know a lot of us have had problems with that, and just, Ephraim's a great accountant, if you have a good accountant or a tax person,